Welcome to one more fresh new chapter, that is risk analysis in capital budgeting. Dear students, risk, what is a risk? Business itself is a risk. See, we know that to generate maximum income in India, there are different types of economic activities are there, like employment, profession and business. Among that, business is at most important thing. If you choose, you can generate the best return. But then why the people will get fear of doing business? Because the risk. So that's why we are not at all show interest to do the business. But the ultimate point is, you should not get the fear both by seeing or watching the business risk. You must develop such a skill to handle that risk. Here there is a chapter for you where it assesses the risk element of project. Risk element of project, it identifies how the risk should be observed and analyzed and how it is systematically mitigated. That's the chapter called, what is that? Risk analysis in capital budgeting. Risk analysis in capital budgeting. See, generally in capital budgeting, whenever we used to evaluate a project, we used to calculate NPV, payback period, profitability index, discounted payback period, all these things. And among these techniques, one of the best evergreen technique is NPV. We soundly made a sound that if NPV is positive, the project should be accepted. If NPV is negative, the project should be rejected. Okay, I too agree. That is worthful. But the NPV, what we calculated, we took the base of certain cash inflows. That cash inflows are not at all certain. Because that cash inflows are not at all certain, in that case, the uncertain cash inflow based NPV, how this is going to protect our project, dear students? Try to understand your project. So generally in evaluation of all the methods, evaluation of a project and all the methods in capital budgeting, we assumed that cash flows are certain. Cash flows are certain. But this is for theoretically, it may be good for you. Cash flows of the certain. Cash flows are certain. Certain. But in practical, the cash flows are not certain. The cash flows involves risk. Cash flows involves risk. So what is the risk? That is the most important. What is the risk? Risk is nothing but uncertainty. Uncertainty of the cash flows is nothing but risk. See, risk versus uncertainty. You should understand this, both the meaning. Risk versus uncertainty. Risk means measurable uncertainty. Uncertainty means non-measurable risk. So there is a small difference. For example, in the coming IPL match, who is going to win? If anybody asks you, Mumbai Indians are going to win. If someone says that, yes, I don't know that, because I don't have any probability to identify. I don't know that what is the systematically I should evaluate. In that case, what happened? That is called uncertainty. You cannot measure the risk or uncertainty. You cannot measure, you cannot apply any of the probability, then it is called uncertainty. Risk means that is the same uncertainty, but you can measure it. For example, if anybody comes and asks me that whether the Mumbai Indians can win the match, then I will take the probability. So far from the IPL history, how many times the final Mumbai Indians went? What is the batting strategy? So how they will perform? What their strength and weakness? Everything I will make it. I will analyze it. Basing on that, if I project some data, that is called risk. So dear students, in fact, in evaluation of a project, the cash flows of the projects, we assumed that there is a certainty. But it is not a certainty. It involves a risk. So there is one more innovative word also hidden along with the risk is uncertainty. Uncertainty means you cannot apply probability, you cannot measure the risk, is called what? Uncertainty. But risk means this is the measurable uncertainty, is called risk. In capital budgeting, we will assume that the impact of risk is measured and systematically its risk element is mitigated, and finally we will take decision making. There are different types of methods around with this concept. Okay, there are different types of risk measuring techniques which are available. One is the conventional techniques, another one is the statistical techniques, another one is other techniques. One is conventional techniques, statistical techniques and other techniques. You see, conventional techniques, risk adjusted discount rate, RADR, which is nothing but risk adjusted discount rate. Thereafter, certainty equivalent factor, Thereafter, statistical techniques, you will have probability, variance, standard deviation, coefficients of variance and expected NPV. So, in this technique, we will calculate expected NPV. If you want to find it out, expected NPV, you have to find it out expected cash inflow. By taking that expected cash inflow only, we will calculate expected NPV. And thereafter, other techniques, that is called sensitivity analysis, scenario analysis, simulation and decision tree analysis. So, these are the various techniques we use to evaluate the project. In our examination oriented rapid batch material, we have a problem. The first of techniques which is given, risk adjusted net present value, That is the first problem we supposed to take from this technique, risk adjusted discount value. So, first problem we are going to do problem number 1. Determine the risk adjusted net present value of the following project. There are 3 projects, project X and project Y and project Z. So, here the point is, this method is risk adjusted net present value. See, generally when we raise the funds, we have to pay certain financing cost. To evaluate a project, that financing cost is just enough. For that purpose, we will take evaluation of any of the project. Sometimes, when that concerned business cash inflow might be uncertainty. Such a concerned cash inflows of the project may not be certain in future. In such a case, the technique what we use is called, what is that? Risk adjusted discount rate. There, instead of taking the exact cash inflow, we will add certain risk premium. Frankly speaking, there we will take some risk free rate plus risk premium, then such a massive discount rate we can use to evaluate the project. In this technique, what happens? As risk of the project increases, risk discounting rate also increases. So, at that risk discounting rate, if the project is positive, then the project is worthwhile for investment. So, that is the ultimate risk evaluation technique of risk adjusted discounting rate. Here, risk premium depends upon, what is that? A risk element. So, you see in this problem, the net cash outflow of project X is 2,10,000, project Y is 1,20,000, Z is 1 lakh. Project life 5 years. Annual cash inflow you will get it 70,000. Project Y is 42,000. Project Z is 30,000. The coefficients of variation for every 1 rupee of deviation, standard deviation, for every 1 rupee deviation is 1.2, 0.8, 0.4. So, as deviation increases, risk element increases. So, here the company selects the risk adjusted discount rate discount on the basis of the coefficient variation. See, when 1.2 is there, you have to choose a 16%. When 0.8 is there, you have to do 14%. When 0.4 is there, you have to choose 12%. So, as risk increases, discounting rate also increases. Here, risk is projected with what? Coefficients of variation. As that coefficients of variation increases, risk element also increases. Now, in this problem, we are going to evaluate each of the projects. Let us take problem number 1. evaluation of each of the projects basing on risk adjusted discounting rate. Risk adjusted discounting rate. So where we used to calculate NPV equal to PV of cash inflow minus PV of cash outflow. Let us take project X. Project X NPV equal to PV of cash inflow. How much of cash inflow it's supposed to get? It 70,000 for every year 5 years. So what the factors? 70,000 into present value annuity factor R percentage n number of years minus PV of cash outflow, that is nothing but the cash outflow would be 2,10,000 rupees. 2,10,000 rupees. 2,10,000 rupees. But here there is no discounting rate directly given. What they said is the coefficients of variation is 1.2. Well, we know that in regular class we taught many times, as coefficients of variation is increases, the expected value deviation is more than 1. So in this case risk element will increase. With effect you have to take 16% would be the discounting rate there. So what we do is 72,000, right? 2,10,000 rupees. So 2,10,000 rupees. So here the factor value would be 16% 5 years. In that case 70,000 into present value annuity factor, that is 16% 5 years minus 2,10,000 as a given in the problem. So 70,000 into 16% factor value is given there. 16% 5 years factor value would be 3.274. 3.274 minus 2,10,000. That is 70,000 into 3.274 minus 2,10,000. That equal to 19,180. Since NPV is positive, 19,180. You got this answer, dear students. So even in project X, the project is worthable to accept. That is 19,180. Coming to project Y. Let us take project Y. Project Y. In project Y, what we do is every year we supposed to get it 42,000 and investment is 1,20,000. So here NPV equal to 42,000 into present value annuity factor. The rate they supposed to take is what rate? That is a 14%. 0.8 means 14%. So 14% and 5 years minus 5 years 1,20,000. So 42,000 into 14 5 years means 14 5 years 3.433 minus 1,20,000. You can make evaluation. So 42,000 into 3.433 minus 1,20,000. That equal to 24,186. Since NPV is positive 186, the project should be accepted. And coming to project Z. Project Z is 30,000 1 lakh. So NPV equals to 30,000 into present value annuity factor. The factor value what we supposed to take is 0.4 means 12%, 5 years minus 1 lakh. Thus NPV equals to 30,000 into 12%, 0.4 means 12%, 3.605. 3.605 minus 1 lakh rupee. So 30,000 into 3.605 minus 1 lakh, that equal to 8,150. You got the answer, 8,150. From this point, what's the conclusion you can draw this? From the given projects, project X and project Y, project Z, as risk coefficients of variation increases, risk elements also increases with a factor, we have taken high discounting rate. Since at that high discounting rate, we evaluated a project, all the projects got the NPV positive. So, if the given projects are mutually independent, you can accept all the projects. Whereas, if the given projects are mutually exclusive, then select the project which has highest NPV. So, this is the way to evaluate a project basing on risk adjusted discount rate. This speaks that more risk, highest discounting rate. So that's why I'm going to give you a 5 minutes what I made a presentation for you right now. So risk analysis in capital budgeting. Life is always matter of risk. Tell me the one space where there is no risk. Everybody have their own perception point of view. Everybody have their risk. Right? The point here is, in capital budgeting, we made a discussion, right? Generally, you see here. While discussing capital budgeting, we took different types of methods yesterday, what I told you, that NPV, payback period, IRR, profitability index, all these things. But we took all these things example by keeping in one thing in mind, that what? The cash inflows are certain. Cash inflows are certain. That is not absolutely right? To make evaluation of any of the project, okay, the financial manager uses various types of methods, but all the methods are not accurate, not perfect. Because when you consider that the cash inflow which is going to generate is certain, then there is no risk, right? But basing on such an assumption, evaluating such a project, okay, even though NPV is positive, if you say that yes, it's a wonderful, bahut acha hai, but it doesn't work, so one fine day you started to cry like this. You started to cry like this because that assumption is wrong. Only that assumption is taken for the sake of to identify various methods. So in this chapter, what explains that even though that methods are wonderful, great, superb, no doubt at all, but the point is the cash inflow, what you supposed to take is that cash inflow you should not consider is a certain. Dear students, the cash inflow of any of the project is in 3 ways. One is under certainty, another one is uncertainty, and which involves risk. So certainty, uncertainty, risk. I already said risk and uncertainty yesterday. Simply what I would like to tell you is, risk is measurable uncertainty, but uncertainty is measurable, unmeasurable risk. I repeat again, risk is measurable uncertainty, whereas uncertainty is unmeasurable risk. That's the difference between risk and uncertainty. Got my point? Right. So in order to evaluate risk, you should understand various sources or various factors which creates risk to business. What are the factors? There is a project specific risk would be there, competition risk would be there, company specific risk would be there, market risk would be, and risk due to economic conditions, and industry specific risk, and international risk. So these are the various factors which directly creates risk to business. Risk to business. So as a financial manager, because of these factors, the cash inflow what you are going to get it is never be certain. Certain. For that purpose, you must evaluate various types of methods to mitigate that risk element. These methods being classified into 3 types. One is the statistical methods, probability, variance and standard deviation, and coefficients of variation. Thereafter, conventional technique, risk adjusted discount rate, certainty equivalent method, and other techniques. Yesterday we discussed risk adjusted discount rate in our material. This is risk adjusted discount rate technique actually. The first technique, first problem in your rapid revision batch problem given is risk adjusted discounting rate. So what this techniques indicates that, so in order to evaluate a project, generally we used to use a cost of capital, investor expected rate. Okay, so because we are raising funds from one source and we are utilizing that funds in somewhere else, right? So we are investing in a somewhere else means here business. That business gives a return, right? So when we calculate the NPV or IRR by taking that given rate, if NPV is positive, we can accept the project, and NPV is negative, we say that reject. But what happens, whatever the project, where what you are starting and where you are starting, let us take if you are doing business in such a desert area. So is it good for you to earn only that given rate? Or if you start the business in such an Iceland area, is it good for you to get that return? No, it's not possible. In that case, what you have to do means, since you are taking much and more risk, so you have to evaluate the project not only risk-free rate but also risk premium. By adding both, you will get it written is called, what is it? Risk-adjusted discount rate. What this risk-adjusted discount rate conveys this method? When risk is bada, discount rate bhi bada hona chahiye. So if the project consists much and more risk, right, the discounting rate what it's supposed to take is also must be highest one. So here the discount rate should be combination of two things. One is a risk-free rate, another one is risk premium rate. That risk premium depends upon the risk. Yesterday we done a problem where we have taken basing on the discounting rate, basing on coefficients of variation. As coefficients of variation is increased, the discounting rate also increased. So that is the first method what they are given. So if it is a regular class means we would have gone with a vivid explanation further, but since here we know that the time constraint, I am giving this updated information. That's enough. Thank you. So let's move with another problem in your rapid revision batch, what they are given. So now in the rapid revision batch material, problem number 2 which is given from examination point of view, again we have taken risk adjusted discount rate. Dear students, let's take the problem number 2. An enterprise is inviting 100 lakh in a project. The risk free rate of return is 7% and risk premium expected by the management is 7%. Risk free rate is 7% and risk premium expected by the management also 7%. The life of the project is 5 years. The following are the cash flows estimated over the life of the project. Okay, dear students, 1, 2, 3, 4, 5 years the lifespan, right? And first year 25,000, second year 60,000, third year 75, fourth year 80,000, means it's lakhs, right? 25 lakhs, 60 lakhs, 75 lakhs, 80 lakhs, 65 lakhs. Calculate net present value of the project basing on risk-free rate and basing on risk-adjusted discounting rate. See, here the risk-free rate is 7%. It indicates it would be the normal cost of capital of the project where the funds would be raised at a given rate. But whereas the nature of the business, what we are doing, basing on that the risk premium also increasing by 7%. So if you evaluate a project by taking just 7%, that is a risk-free rate evaluation. But whereas considering risk premium, if you mitigate the risk, if you try to reduce the risk element, then you have to take 7 and again 7. 14% should be evaluated. Got my dear students? Now we do the problem. Here the point is how we have two parts which are given. Let us take here problem number 2 in rapid revision batch. So problem number 2. So evaluation of a project. Evaluation of a project basing on risk-free rate. This is part A. basing on risk-free rate, that is 7%. Okay, 7%. Let us take evaluation means what are we going to calculate NPV. What is the formula of NPV? NPV equal to PV of cash inflow minus PV of cash outflow. Let us, in this problem, so the cash outflow would be 100 lakhs, 1 to 5 years would be there, and every year cash inflow changes, you have to take the factor value 7%. Let us, so evaluation of a project basing on risk-free rate, that is 7%. So what you do is, let us take year, that is 0 period you are going to make investment, first year, second year, third year, fourth year, fifth year. These are the cash inflows you are supposed to get from the given project. Let us imagine the cash flows of the project. Cash flows is nothing but 100 lakhs you are going to make, and first year 25, 60, 75. 25, 60, 75 would be cash inflow, and 80, 65. 80 plus 65. The point thereafter is you have to make evaluation. For that purpose, what you take, you will take risk-free rate, that is a PV factor at 7%. 7% either is 1, whereas the factor value, could you get the problem? See, whatever the factor value is given, you have to take only that factor value, otherwise you can calculate. So factor value already which is given, if not there, go to the table and you can follow, otherwise calculate 1 divided by 1.07, that equal to 0.934 is given, but they have taken 5. You can take, because 9345, you can take it 4 or 5, doesn't make any sense, right? So this is 0.935, then 0.873, next 0.816, next 0.763, next 0.713. So this would be the factor value, we should take it. Okay, dear students, now what to do is you can multiply this cash inflows which you supposed to get in various different years, you can bring into present. 100 into this 100, okay, 100, this would be outflow. So 25 into 0.935, 25 into 0.935, that equal to 23.375. Okay, 25 into 0.935, that equal 23.375. Thereafter 60 into 0.873, 52.38. You can also take the calculator and you can also work it out. Okay, 75 into 0.816, that equal to 61.20. 80 into 0.763, that equal to 61.04. 65 into 0.713, that equal to 46.345. Once again I repeat, 100 into 1, that is 100 as usually. Okay, 25 into 0.935, 23.375, 60 into 0.873, 52.38. Next is 75 into 0.816, 61.20. 80 into 0.763, 61.04. 65 into 0.713, 46.345. Now, what is the total cash inflow? So you got it. You got the two things. One is a PV of cash inflow minus PV of cash outflow. Now, basing on this value, you can comfortably calculate NPV, right? What is the NPV formula, please? Could you repeat? Not repeat. Tell please. Spell it out. NPV equal to PV of cash inflow minus PV of cash outflow. So the total cash inflow, what you're supposed to get it is 23.375 plus 52.38 plus 61.20 plus 61.04 plus 46.345, right? Total 244.34 minus 100. It would be 144.34 plus or minus basing on the factor value. You will get it 144.34. How much they have given? Yeah, 144.34. So they got the same value. Now tell me, what is the conclusion you can draw? Conclusion is, if the cost of capital is 7%, the discounting rate is 7%. At the 7% rate, the NPV of the project is 144.34. It is a wonderful positive NPV. So the project could be accepted. So you can write the conclusion. Since decision, or the conclusion you can write, since NPV is positive, it is advisable to accept the project. Since NPV is positive, it is advisable to accept the project at given 7% rate. So this is the first method. Coming to, you have a part 1 is finished. Now you have a part 2. In this part 2, what you are going to evaluate a project basing on risk adjusted discounting rate. So evaluation of a project basing on risk adjusted discounting rate. Evaluation of a project basing on risk adjusted discounting rate. See, risk adjusted discounting rate equal to, it's a combination of two things. One is risk free rate plus risk premium. Risk free rate plus risk premium. Risk free rate how much? 7%. Risk premium is 7%. You have to take 14%. So in 14%, by taking this 14%, if you evaluate the project, if that project gives NPV positive, then the project is worthwhile to accept. Okay, let's. So here also we do the same thing, but here 0, 1, 2, 3, 4, 5. The cash flows associated with the project are 100 is the outflow, 100, 25, 60, 75. 25, 60, 75. Then 80, 65. 80, 65. So you have to take what factor? You have to take the factor value. That is nothing but risk adjusted discount rate, 14%. That's PV factor at 14%. For 14%, you can take the calculator. The table would be given. If not, you can use this factor value table. Factor to find it out, present value factor 1 divided by 1.14, that equal to 0. This is the first year. For second year, 0.877. Second year, 0.769. Third year, 0.675. Fourth year, 0.592. Last year, 0.519. So these are the factor value. Now find it out present value. 100 into 1, 100. Okay. Next 25 into 0.877. So 21.925. 60 into 0.769, that equal to 46.14. Next 75 into 0.675, that equal to 50.625. Next 80 into 0.592, that equal to 47.36. Next 65 into 0.519, that equal to 33.735. So here point is 100. The total cash inflow, if you see once again, 25 into 0.877, that is 21.925. Okay. 60 into 0.769, 46.14. Okay. 75 into 0.675, 50.625. Okay. 80 into 0.592, that equal to 47.36. Okay. 65 into 0.519, 33.735. Okay, right ma? Now what to do is you calculate NPV. Well, we know that NPV formula, NPV equal to PV of cash inflow minus PV of cash outflow. Got it? So let us calculate what is our total cash inflow. 21.925 plus 46.14 plus 50.625 plus 47.36 plus 33.735, 199.785, or you can say 200. Let us check it what the answer they have given. It is 199, you know. That is the total cash inflow. You supposed to deduct cash outflow. Balasubramanian ji, kya bhul gaya kya tu? From that, if you deduct 100, it would be 99.785. Not this 100, please. This is the total cash inflow, right? From the cash inflow, you have to deduct the cash outflow. Okay. Here you got the NPV positive. So here also at the risk adjusted discount rate also decision, what you can conclusion or decision you can write. Since at risk adjusted discount rate or at risk adjusted discount rate, the project's NPV is positive. So it is advisable to accept the project. Advisable to accept the project. Okay. That is, check it once again. How I calculated. I took first risk adjusted discount rate 7% and I calculated NPV. I draw the conclusion. Thereafter, I took risk adjusted discount rate, which is a combination of risk free rate and risk premium. I took the 14% and evaluated the project. So at 7% and 17%, the both aspect for both the discount rates, the project NPV is positive, so project could be accepted. So this is the problem. With this, we concluded problem number 2. Let us check what is the point they have given. So the next problem, problem number 3, where this problem is based on certainty equivalent factors, CE factor based. It means that you need a small presentation here. I will give you. One of the technique is nothing but certainty equivalent method or certainty equivalent factor based NPV. See, dear students, business is a matter of risk, no doubt at all. But by observing, by knowing, by analyzing risk element of business, if you quit the business, it's not a great thing. You would be called a timid person. So what you have to do is you have to learn the subject and you have to mitigate the risk element and you have to handle the project. You see, in some families, often I used to read, I will find in newspaper that the family members made an attempt at suicide because of some family disputes, family problems. But if you observe very carefully, how many people are there in the family means hardly 5 to 7 members, like hardly. So let us maximum 5 kids, 2 parents, or 3 kids, 2 parents and their parents too. Let us take. See, when you are not able to handle hardly 7% relationship, how a chief minister handles one state relationship? Try to understand. And how the Prime Minister of India handles a country, if it is in a political aspect point of view. But if you think from business point of view, try to understand biggest company like Coca-Cola, Pepsi, these companies, they do the massive business, right? Do they fear? For example, you take KFC chicken, Pepsi, Thumbs Up, Apple, Adidas. These are the companies which are doing multinational business. That in how many countries, how many aspects. In India, you can take the Reliance, also one of the best. So it means that everywhere, every business risk is there. But you should not get fear of risk. You have to create fear to risk actually. And you have to solve the problems. So in order to mitigate the risk element, we learned previously risk adjusted discount rate. Here we are going to do is certainty equivalent factor. So certainty equivalent factor means here we cannot assure normal cash inflow to evaluate a project. We will think that how much certainly we used to get it. We will find it out how much the cash inflow we supposed to get it. Here what we do is we will take first uncertainty cash inflow, certain cash inflow. For the given uncertainty cash inflow, you are getting certain this much. Convert into percentage. Uncertain cash inflow divided by certain cash inflow, you will get it certainty equivalent factor. So this may be the industry where we are working, or this may be the data the client gives you. So by taking that one, okay, with the certainty equivalent factor, if you multiply the certainty equivalent factor with the uncertain cash inflow, so you will find exactly certain cash inflow. By taking that certain cash inflow exactly, if you evaluate the project at that rate, if a project gives positive NPV, then project should be accepted. I repeat again, here you see certainty equivalent factor is the ratio assured or certain cash inflow to uncertain cash inflow. From the given uncertain cash inflow, how much certainly cash inflow is coming? That is nothing but for every 1 rupee. For example, 0.75. What is this 0.75? For every uncertain cash inflow, you are supposed to get it 0.75. This is the exact cash inflow you are supposed to get it. Or 0.25. You will expect 1 rupee you are going to get it, but exactly you will get 0.25. So if you evaluate a project basing on that 25 factor, that is called CE factor. But you cannot take directly that factor, right? You are going to multiply with that uncertain cash inflow, you are going to get a certain cash inflow. That certain cash inflow would be considered to evaluate a project. At that certain cash inflow, if project gives a positive NPV, then the project should be accepted. Okay, that is what we have to do in this aspect. First of all, convert uncertain cash inflow into certain cash inflow. How should I convert uncertain cash inflow into certain cash inflow? Very simple. Take uncertain cash inflow, multiply with the certainty equivalent factors. You will get the certain cash inflow. Okay. What is the next step? Next step is take that uncertain cash inflow and evaluate the project. Take discounting rate and evaluate the project, calculate NPV. If NPV is positive, then project should be accepted, otherwise rejected. Sir, okay, in discounting rate, what rate we should take, sir? Should we take a risk adjusted discount rate or should we take a risk free rate, sir? The point is, Already you mitigated the risk element of the project by considering CE factor. If you take a risk premium, then it would be double impact, then it creates double impact. So what I would like to tell you to dear students, you should consider only risk-free rate, because the risk is already mitigated by taking certainty equivalent factors. Got it my point? Let me tell you what are the steps, please. Could you repeat? Step number 1, convert uncertain cash inflow into certain cash inflow. How, sir? Uncertain cash inflow with a certain factor, certainty equivalent factor, man, you will get certain cash inflow. And taking that certain cash inflow, you can evaluate the project. If the project gives positive NPV, the project is worthable, otherwise reject. Got? So this is the basic point I would like to explain with you, and now we will move to problem number 3, which is given in your material, right, ma? Right. The Textile Manufacturing Company Limited is considering one of two mutually exclusive proposals. Project M and N, which require the cash outflow of 8,50,000, 8,25,000. One project requires 8,50,000, another project required 8,25,000 respectively. The certainty equivalent factor approach is used to incorporate risk in capital budgeting decision. The fact what is given is the certainty equivalent factor approach. This approach should be used. There are different types of method I already told. Discounting techniques, statistical techniques, conventional techniques. So in this project, you should evaluate basing on certainty equivalent approach only. Right? The current yield on government bond is 6% and this is used as a risk-free rate. Currently it is being considering risk-free rate 6%. Sir, should we take risk premium? Just now I told you that no, you are already mitigating. You are mitigating, you are reducing, you are hedging the risk by taking certainty equivalent factor. Then how do you take again risk adjusted discount rate or risk premium rate? You should not take it. Right? So cash inflow first year 1, 2, 3. First year 4,50,000, 5 lakhs and 5 lakhs again. The CE factors is given 0.8, 0.7, 0.5. For means for first year for every 1 rupee you are supposed to get 80 paise, or else for 100 rupees you will get 80%. For second year for every 1 rupee you used to get 0.7, or 70% income is confirmed for every 100 rupees. Third year 0.5. So if you come to the project N, 4,50,000 your investment, your cash inflow, but 4,50,000 second year, 5 lakhs would be the third year. Whereas the CE factor 0.9, 90%, or for every 1 rupee, 9 rupees is confirmed. For every 1 rupee, 90% confirmed, sorry. And second year 4,50,000, that would be 0.8. Third year 0.7. So these are the factors value. Okay. The present value factor 1 rupee discounted at 6% at the end of 1, 2, 3. The factor value also given 0.943, 0.890, 0.840 respectively. Which project should be accepted if risk adjusted discount rate method is used? Which project should be appreciated with the high rate and why? This is the problem we have to work it out. Got my students? Which project should be accepted? What you do, sir? We are going to calculate NPV basing upon certainty equivalent factor. If NPV is positive, project should be accepted, otherwise rejected. Got it? Okay. Let us do problem number 3. So what we do is evaluation of, this is part A. Evaluation of each of the projects basing on certainty equivalent factor. basing on certainty equivalent factor. Let us take you have project N and M, right? Project M and N. Let us first of all we do project M. Project M, you see, first year you take it. Year, 0 period investment. First year, second year, third year. Only 3 years cash inflows are there. 1, 2, 3. So the cash flows would be $4,50,000, 5 lakhs, 5 lakhs. For the investment here, 4,50,000, 5 lakhs. Okay, 5 lakhs. What about investment? Investment is confirmed, certain 8,50,000 rupees. So 8,50,000. Now, certainty equivalent factors. If you take certainty equivalent factor, for rupee value, it would be 1 rupee only. Whereas for remaining factor value, they have clearly mentioned how much they are supposed to get it. For here, 0.8, 0.7, 0.5. 0.8, 0.7, 0.5. Okay, 0.8, 0.7, 0.5. Okay. Now what to do is, if by multiplying this cash inflow with this certainty factor, you will get it certain cash inflow. So take certain cash inflow. The certain cash inflow, this would be outflow, you know. So 8,50,000 would be your outflow. 4,50,000 into 0.8, that equal to 3,60,000. 5 lakhs into 0.7, that equal to 3,50,000. 5 lakhs into 0.5, that would be 2,50,000. So the point is 2,50,000 plus 3,50,000 plus 3,60,000, that would be 9,60,000 minus 8,50,000. That equal to, you will get the NPV just you got only certain cash inflow, you know. Now where you will find it? This you got the certain cash inflow. What the next step you have to do? You have to do PV factor at 6%, because discounting rate is 6%, you know, right? 6%. Table is not given. Then don't worry. Use the formula to calculate this one. So 1 divided by 1.06, that equal to 1 here. Second year it would be 0.943. $0.889, 0.840. These are the factor values they used exactly. 890, 840, yeah. You can take 890, no problem, exactly. Now you can multiply this factor value, PV factor. So 1, you will have 8,50,000 into 1. You will get it 8,50,000 as usually. So 3,60,000 into 0.943, that equal to 3,39,480. I repeat again, 3,60,000 into 0.943, that equal to 3,39,480. So 3,50,000 into 0.889, that equal to 3,11,150. Then 2,50,000 into 0.840, that equal to 2,10,000. Now you can calculate, evaluate NPV, the discounted cash inflows, which we brought it already present. That would be 3,39,480 plus 3,11,150 plus 2,10,000, 8,60,630 minus 8,50,000, that would be 10,630. I repeat again, 3,39,480 plus 3,11,150 plus 10,000 minus 8,50,000, 10,630. Because of small factor value, answer will be bit different, because they have taken one value, I have taken one value. Basing on that, you will get it at 10,640, 650 is approximately. So since NPV is positive, this project is acceptable, basing on project M. Now, this is project details with respect to M in the given certainty factor value and the given factor values, right?
Hi students, I am Prakash, Academic Advisor, Masterminds. Just now you have watched a sample video of our rapid revision batches for CA Inter level. So we are very happy to say that we have developed this kind of rapid revision batches for all the subjects of CA Inter and IPCC level. And if you are interested, then you can directly purchase rapid revision batch videos of your choice from our app. So first of all, you please do install our Android app Masterminds Online Classes from Google Play Store. So after that, click the option Store. After that, select the filter CA Inter RRB. CA Inter RRB. Yeah, here it is, CA Inter RRB. So whatever the subject you want, you can purchase the same. And for each video, there will be around 6 months of validity. That means whenever you purchase a course, there will be 6 months of validity. That means you can watch at any time before 6 months after the date of purchase. And we will be giving 1.5 views. That means each 1 hour of video you can watch for around 1.5 hours. And these videos can be watched directly in your mobile phone. And if you belong to iOS platform, then please do install an app called Class Plus and enter the organization code as MZGUN. I hope that you liked the sample video of RRB subject being uploaded by us, and please do subscribe this channel so that you can receive a notification whenever we add a new video, and also press the like button if you really like this video, and also press the bell icon so that you will receive a notification. And please do send a mail to my mail ID if at all you have any academic doubts or issues. My mail ID is mssprakash2012@gmail.com. So once you visit our app, not only RRB videos, you can find large number of other videos also. If you belong to CA Inter, then so in the filter section you can select the option CA Inter. Then all the videos related to CA Inter will be visible to you. So just now I have pressed the option of CA Inter. Now all these are the videos available for CA Inter. For example, if you want to watch the videos of a particular subject at CA Inter level, or a particular chapter at CA Inter level, either of regular batch or crash batch, all such videos are already available in the app. So The videos related to CA Inter regular batches, videos related to CA Inter crash batches are already available in this app. Either you can purchase a particular subject or sometimes even some few chapters or even the entire group you can purchase directly from the app. That is the convenience with which you can watch the videos by installing our app. All the best. Let's have a glimpse into the roots of the masterminds. So masterminds were established in 2002 and is undeniably the pioneer and the leader in MEC, CA and CMA coaching in India with a lion's share of nearly 20,000 admissions per annum. It is an incredible initiative by three visionary edupreneurs. That is me, MSS Prakash, Chartered Accountant, my brother Mohan, my sister-in-law Radha. From the same family at a very young age under the successful mentorship of our father, Mr. M. Sivaprasad. Within the shortest span, our presence have expanded to almost all major cities of AP and Telangana. We are humbled to say that very soon we want to expand to the states of Karnataka and Tamil Nadu also, so especially with the wishes and support of all our old students. We offer best quality services for MEC with integrated coaching for CRCMA Foundation. Exclusive MEC CEC coaching is also available. Regular class, study hours and revision exams, MMTS services for all the levels of CSCMA courses. And recently we launched a unique academic program called MEC Pro, aiming the students who aspire to pursue BBA, CLAT or MBA in future rather than CSCMA courses, and we have received excellent response. So our students have achieved first rank for 47 times in various courses that we offer coaching. Till now, our students have bagged 977 All India ranks in all the stages of CSCMA courses. So 98 All India ranks in a single attempt of CMA inter and final exams. And 180 All India ranks in CSCMA courses in 2019 and 20 alone. So 3 All India first ranks in the year 2020 alone. So right now we have around 150 batches of various courses in Guntur and all our branches together.